Interest rates are on the rise. That's right. You heard me correctly. Interest rates are going up. What does that mean? And what are the implications? I've got that and more coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Anytime someone's been talking about interest rates for the past 10 months, really since March, it's been, oh, they're at record lows, or they're at zero, or the Fed's keeping rates at zero. Yeah, that's actually starting to change. And the Fed continues to beat the same drum over and over and over and over again, by the way, which we'll just continue talking about what in the world the Fed is doing. However, interest rates are actually on the rise. I'm not talking about the Fed's interest rate. I'm talking about the interest rate that the open market, the free market, is actually making. Let me explain what that means. Okay, so this is the best little chart that I can draw here, and this is sort of a basic overview. So for those of you that are very familiar with the yield curve and understand interest rates, let me just get through some basic stuff here first, and then we're going to talk about implications. But there's interest rate here, the amount of the interest rate, and then there's time down here. Okay, so these are the very, very, very short-term interest rates, the very, very short-term loans, and then these are long-term loans. So think of, 30-year mortgage, right, or a 30-year bond. Maybe Disney, doing some sort of expansion or whatever, is issuing bonds that they're willing to pay interest on for the next 30 years, and then you'll get your principal back 30 years from now. Obviously, with interest rates being so low and having dropped so low, lots of strong businesses want to do that. They want to restructure. They're willing to take on debt right now at these low interest rates and say, yeah, I'll pay back over 30 years. Sure, that's fine. That's no problem. So all of these interest rates are at play each and every day. Okay? How are these interest rates set? Well, the only one that there's actually fixed pricing on, pricing control, is the overnight rate. Did you know banks lend money and borrow money and whatever overnight to meet their reserve requirements, their depository requirements? They do. And if you're a Bitcoin lover, you might want to tune to that video, because there's all sorts of back and forth stuff overnight over how much banks need to keep in their cash reserves, and it's all electronic now. And so it just opens the door for some sort of Bitcoin or some sort of central bank digital currency. And so I'm not going to go there, but just anyway. So this overnight lending rate, that's the interest rate the Federal Reserve controls. That's the one that the Fed says, okay, we get to pick that interest rate, and they manipulate this interest rate based on their monetary policy, whether they want to boost lending or discourage lending, right? And so for a while, they've kept it at zero. And they've actually said, hey, we're going to meet a bunch of times this year, but we're not changing this number for a couple more years. I mean, maybe in 2023. Maybe. That's unbelievable. So they're going to keep this one, the overnight rate, at zero. But then the 1 day or 2 day, the 1 week, the 30-day, the 6 month CD, the 1 year, all of that trickle off of this. And normally the yield curve is going to look something like this. So at any given day, that wasn't meant to be a little tail there, it's supposed to flatten out. At any given day, you could just spot check what are these interest rates, and this one the Fed's going to fix at zero, and the rest of them are going to be influenced by buying and selling, by the purchases, by the free market. But it's not free because it's all Fed manipulation now anyway. But this is what is considered the yield curve. Okay, you would expect an overnight loan is not as risky as a 30-year loan, right? So you would expect the yield curve interest rates to be going up over time. The short-term rate, not a lot of risk, so that should be low. The long-term loan, the long-term rate should be higher because the risk is higher. Disney today seems like a juggernaut, or at least they did before the pandemic. But I'd be willing to lend money to Disney. Yeah, I'm pretty sure they're going to be around in 30 years to pay that back. It's not guaranteed. They might not be able to, but I think that's a safe bet, but not as safe as just lending money to the government overnight, right? So interest rates should go up. Over time, by the way, what's predicted 12 of the last 7 recessions or bear markets, yes, you heard me right, is when we get an inverted yield curve, because what happens is the federal government, as the economy gets pumping and gets going, the Federal Reserve, I said federal government, that's funny. That's a little Freudian slip there for those finance geeks like me. The Fed influences starts pushing up their rate, so they've now pushed this rate up higher, which should mean everything else follows suit. But if the open market, if the economy isn't operating as well as it should, then the Fed is pushing this rate up, but long-term interest rates aren't able to be pushed up. And now you have short-term rates higher than long-term rates. That's called an inverted yield curve. For you Top Gun fans out there, we were inverted, and that's a problem. That has happened before every bear market since in the last 50 years, okay? And don't quote me on that, but every single one. Sometimes it happens and then we don't have a bear market. But every time we've had a bear market, that has happened. Okay, so let me erase this line and get back to today's topic, because the Fed has come in and said, we're keeping rates low. We're keeping rates low, no change, we're not doing anything. I totally personally disagree with that stance. I really do, but they know more than I do, and they're juggling more. However, we're starting to see pressure on these rates. If you look at the 10-year Treasury, if you look at longer-term interest rates, they have gone up considerably. They have gone up considerably. So basically, we're starting to see a very steep yield curve. And that has implications as well. You might hear people on CNBC or other financial news networks, they're saying, hey, the yield curve is steepening, that's gonna be bad for stocks. They don't stinking know. They don't know. What does this mean? What are the implications of this? I've got 3. Number one, your savings account is still gonna be stuck at 0. It is. What you're getting paid in interest from the bank is going to stay very short term. Yeah, but what if I get that 1-year CD or that 3-year CD? Guys, we're still right in this pocket here. As long as the Fed says we're keeping their rate, their rate at 0 or as close to 0 as possible, you're not going to see your savings go up, the interest on your savings account go up at all. So get used to that and be wise about your decisions on what you do with cash. It did a video about whether you should use cash to buy a rental or use a mortgage. Just be wise. Make sure that decision as to how much you keep in cash for emergency or financial confidence or future spending, that all is consistent with your entire financial situation, all 6 areas. So that's the first takeaway. When you hear me say interest rates are going up, that's not your savings account, your money market. Those rates aren't going anywhere for a while, it looks like. Second implication is, as these rates are going up, that could be problematic for your bond mutual funds, your bond investments. Speaking of inverted, how bond mutual funds work, as interest rates go up, bond values go down. Okay, and maybe we can do a whole video about how that works, but as interest rates start going up, existing bond values go down. So if you're holding a bond mutual fund and interest rates start going up, you might see your bond mutual funds go down in value. Now, there's a pro and con with that. That means that bond mutual fund will be able to buy new bonds or invest in new bonds at higher interest. Well, that's great, but in the short term, you would see the value of your account going down. So I would just be aware of that, and I would encourage you, be careful with long-term bonds. Long-term bonds have had an unbelievable track record going back to the 1980s when interest rates were at a peak, and we've seen interest rates steadily decline since then. Are we going to see the opposite come true? I don't know, but if you look at the history of long-term bonds, the performance has been stellar. I'd be careful right now. I would. I'd be careful right now. So that's That's the second thing. Be aware that there's going to be pressure on your bond mutual funds, and especially be wary of long-term bonds. Maybe shift a little bit closer. The third is connected to that, and that's more of the action item today, and that is bonds. A bad day in stocks is a bad year in the bond market. I say that because the volatility is just very different. So when I say watch out for bonds, if interest rates continue to rise, bond mutual funds might underperform. I'm not talking about the way stocks underperform. So what I mean by this is don't go out and then put all of your money in stocks. Make sure that you're making your overall risk decision based on your comprehensive financial plan. Part of the reason why you could argue stocks have gone up so much is because interest rates are down. And so there's no place else to put money and try to get yield, so you go into the stock market. Just be careful with that. So make sure that you're holding bonds for the right reasons, but because of this pressure on interest rates and what that might mean for bonds in the short term, consider having a momentum or dynamic approach with your bond funds. I would consider that. Either look at getting a fixed interest rate yourself or being dynamic, being momentum based with your bond investments. I am not saying don't have any bonds. Okay, rarely does that line up with someone's risk tolerance as they're in their 50s, 60s, 70s, and 80s. Okay, if you're young, absolutely don't have any bonds, certainly right now. But if you need to be balanced in your risk, I'm not telling you not to get bonds. I'm telling you to just use it in a momentum, either get a fixed rate or use it within a momentum type strategy. Work with your CFP on how all of this fits within your financial decisions. If you don't have a CFP, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, or wisemoneyshow.com. All right, there you have it. Go out and take your next wise step in your financial life.